Risk management and compliance. Leading principle. Market participants are expected to promote and maintain a robust control and compliance environment to effectively identify, manage, and report on the risks associated with their engagement in the FX market. 1. Frameworks for risk management, compliance, and review. Appropriate risk management, compliance, and review structures should be in place to manage and mitigate the risks that arise from a market participant's activities in the FX market. These structures vary in complexity and scope, but generally share some common aspects. For example, the responsibility rests with the business unit which owns the risk it incurs in conducting its activities. In addition, there may be both a risk management function that oversees risk-taking activities and assesses those risks independently from the business line, and an independent compliance function that monitors compliance with applicable law and standards. Finally, there may be a review or audit function that provides independent review of, among other things, internal control systems and the activities of the business unit and the risk management and compliance functions. Periodic independent reviews of risk and compliance controls should also be undertaken, including a review of the qualitative and quantitative assumptions within the risk management system. The principles below describe numerous recommendations that illustrate how to achieve robust frameworks for risk management, compliance, and review. However, not every recommendation may be appropriate for every market participant. Accordingly, market participants should assess which recommendations are appropriate based on the size and complexity of their FX market activities and the nature of their engagement in the FX market, taking into account applicable law. Principle 24. Market participants should have frameworks for risk management and compliance. The common components of these two frameworks may include effective oversight by the senior body or individual, consistent with Principle 4, including support for the stature and independence of risk management and compliance. In particular, the senior body or individual should make strategic decisions on the risk appetite of the FX business. The senior body or individual should be responsible for the establishment, communication, enforcement, and regular review of a risk management and compliance framework that clearly specifies authorities, limits, and policies. Risks should be managed prudently and responsibly in accordance with established principles of risk management and applicable law. The provision of concise, timely, accurate, and understandable risk and compliance-related information to the senior body or individual. The appropriate segregation of duties and independent reporting lines, including the segregation of trading from risk management and compliance and from deal processing, accounting, and settlement. While risk managers and compliance personnel may work closely with business units, the risk management and compliance functions should be independent of the business unit and should not be directly involved in revenue generation. Compensation structures should be designed not to compromise such independence. Adequate resources and employees with clearly specified roles, responsibilities, and authority, including appropriate access to information and systems. These personnel should have appropriate knowledge, experience, and training. Principle 25. Market participants should familiarize themselves with and abide by all applicable law and standards that are relevant to their FX market activities and should have an appropriate compliance framework in place. An effective compliance framework should provide independent oversight and control and could comprise, but is not limited to, identification of applicable law and standards that apply to their FX market activities. Appropriate processes designed to prevent and detect abusive, collusive, or manipulative practices, fraud, and financial crime. And to mitigate material risk that could arise in the general conduct of the FX market activities. Capturing and retaining adequate records to enable effective monitoring of compliance with applicable law and standard. Well-defined escalation procedures for issues identified. Consideration of the need to periodically restrict relevant personnel's access through measures such as mandatory vacation to facilitate detection of possible fraudulent activities. The provision of advice and guidance to senior management and personnel on the appropriate implementation of applicable law, external codes, and other relevant guidance in the form of policies and procedures and other documents such as compliance manuals and internal codes of conduct. Training and/or attestation processes to promote awareness of and compliance with applicable laws and standards. Appropriate implementation and utilization of compliance programs. The periodic review and assessment of compliance functions and controls, including mechanisms to alert senior management about material gaps or failures in such functions and controls. The appropriate senior body or individual should oversee the timely resolution of any issues. Principle 26. Market participants should maintain an appropriate risk management framework with systems and internal controls to identify and manage the FX risks they face. Effective risk management starts with the identification and understanding by market participants of the various types of risks to which they are exposed, and typically involves the establishment of risk limits and monitoring mechanisms, as well as the adoption of risk mitigating and other prudent practices. An effective risk management framework could comprise, but is not limited to, an appropriate and well-documented approval process for the setting of risk limits, a comprehensive and well-documented strategy for the identification, measurement, aggregation, and monitoring of risks across the FX business, including, for example, risks that may be specific to a market participant that intermediates client trades as a prime broker or that provides market access. Documented policies, procedures, and controls which are periodically reviewed and tested to manage and mitigate risks. The clear communication of risk management policies and controls within the institution to promote awareness and compliance, as well as processes and programs to facilitate the understanding of such policies and controls by personnel. Information systems to facilitate the effective monitoring and timely reporting of risks. Robust incident management, including appropriate escalation, mitigating actions, and lessons learned. Robust risk assessment for all products, services, and procedures to identify new or emerging risks. Sound accounting policies and practices encompassing prudent and consistent valuation methods and procedures. An appropriately robust risk control self-assessment process that includes processes to remediate identified gaps or weaknesses. Certain market participants provide credit intermediation and/or market access to other market participants, for example prime brokers and FX e-trading platforms. These market participants should have a risk management and compliance framework that takes this activity into account. In addition, these market participants are encouraged to engage in ongoing dialogue with those for whom they are providing credit intermediation and/or access to the market to underscore expectations regarding appropriate behavior in the market. Principle 27. Market participants should have practices in place to limit, monitor, and control the risks related to their FX market trading activity. These practices could comprise, but are not limited to, the regular monitoring of trading activities, including the identification and internal escalation, as appropriate, of failed, canceled, or erroneous trades. Automated or manual monitoring systems to detect actual or attempted market misconduct and market manipulation. Relevant personnel should be qualified to detect trading patterns that may suggest unfair or manipulative practices. Market participants may use certain statistics or metrics to flag behavior warranting further review, such as off-market rates, repetitive orders, and unusually small or large orders. There should be appropriate processes whereby suspicious practices can be promptly reviewed and escalated as appropriate. Verification of the valuations used for risk management and accounting purposes, conducted by personnel independent of the business unit that owns the risk. Independent reporting on a regular and timely basis of risk positions and trader profit loss statements to the relevant risk management function or senior management, as appropriate, including a review of exceptional deviations of profit loss from expected levels. Transactions should be promptly and accurately captured so that risk positions can be calculated in an accurate and timely manner for monitoring purposes. Regular reconciliations of front, middle, and back office systems with differences identified and their resolution tracked by personnel independent of the business unit. Timely reporting to a senior body or individual when risk limits have been breached, including follow-up action to bring exposures within limits, and any appropriate measures to prevent a recurrence. Appropriate controls around proper order and quote submission, such as kill switches or throttles in the case of electronic trading submissions. These controls should be designed to prevent the entry or transmission of erroneous orders or quotes that exceed preset size and price parameters, as well as financial exposure thresholds. Market participants should be aware of the risks associated with reliance on a single source of liquidity and incorporate contingency plans as appropriate.